A new story came out today that walks us through a pretty convincing theory as to where the economy is heading over the next year or so as our monetary system further entrenches itself into what's known as the death spiral. That's the big story I'm covering in today's housing market update, and you're going to want to know what it means. So stick around to the end and let's get started. This is your first time to this channel and you want to know everything about living, buying, and selling in Southwest Florida, then subscribe and tap the bell for notifications so you can be the first to know about the latest data, tips, and tours to keep you ahead of the curve. I'm Rick Harrison with the Home Sold Guarantee Group at MVP Realty here in Southwest Florida, and my team and I are getting calls, texts, and emails every day from people just like you looking for help on making their move to the greater Fort Myers area, and we absolutely love it. So whether you're moving in 9 days or 90 days, give us a call, shoot us a text, or send us an email so we can help you figure out exactly what you want and where you want to be. All our information is in the description below. So as I mentioned, the big story of the week is the death spiral we are falling into further, and I'll be going over exactly what that is, what it means, and why it's important. But first, let's look at the latest trends in the housing market. All right, so new listings went from 958 last week to 993 for the southern part of Southwest Florida. That's from Cape Corals on to Naples. That's up 3%. Just up slightly, really not a huge change here, but still good news. We are still seeing the momentum and the trends continue. More inventory coming on market. Solds went from 551 to 651. That's up 18% week over week, which is quite a bit. Again, though, that's a lagging indicator, so that's already what happened over a month ago. And then pendings, what's going on right now in the market. This is people who are actually putting homes under contract. That went from 996 last week to 1138. So that's up 14%. So we are seeing more buyers entering the market again. Keep in mind the interest rates did go down the last couple of weeks, but they are starting to head higher. So that's something we'll have to keep an eye on. I think we're going to see that slow down again. Latest inventory breakdown. Single family homes went from 5522 last week to 5468. That's actually down 54 this week. Still not huge because we have been pretty close to all-time highs for inventory coming on the market, but still it is down a little bit. Condos 2907 to 3005. That's up 98. So we had a net gain of units last week, 122. Net gain of 44 this week. So we are still seeing inventory increasing. However, a majority of that is from condos. Multifamily is not much of a change. We lost 6. Foreclosures, we lost 1. Neither of those have really been changing over the last several months. But total sales, 511 total sales week over week over the last 7 days. And out of those, 299, which is 59% of them, were cash sales. So still a majority of the market is buying right now in cash. This is going to be the month over month and year over year comparison charts for the southern part of Southwest Florida. Compared to January 2022, the median sales price barely rose 0.2%, so it's barely up. And then month over month, it also barely rose. So we're really starting to see, as we have for the last month or two, prices have stagnated. Some weeks they're going down, some weeks they're going up. Closed sales, way down, down 30% over the past year, down 17% over the past month. So that's really declining quite a bit. We have seen a lot more cancellations in new construction as well, so that's another point to keep in mind. Median days on the market, that's up 220% from last year, up 6.7% from last month. That's up to 32 days on the market, so that's a full month at least sitting on the market. List price received, that's down. We were seeing over 100% for quite a while during 2022. Now that's down below 100%. We're at 96% of asking price. Sold price per square foot, 264. That's actually up 3.9% from last year, and it's up 1.1% from last month. New listings up 20% from last year and up 55.6% from last month. So that's quite a big increase in inventory as we've been seeing, and I've been covering over the last couple of months. Active inventory up 38% from last year, down 3.2% though from December. So this is January's, just to keep in mind. And then months of supply, 89.8% increase from last year, 16.8% increase from last month. That months of supply, we're at 4.8. We're really, when you're considering from Cape Coral to Naples, we're really closer to the 6 month. We're right around 5.4 to 5.6 months of inventory on the market, which is pretty close to a balanced market. For the northern part of Southwest Florida, Punta Gorda up to Sarasota, new listings went from 724 last week to 763. That's up 5%. So again, same trends, increasing inventory. Solds went from 404 to 534. Lagging indicator, that's up 32%. And then pendings, 777 to 879. Almost up 100 units sold over the past 7 days. That's up 13%. So that is what's going on in the market. And I think, again, like the southern part of Southwest Florida, we will see that decrease over the next couple weeks because mortgage rates are headed back up. Inventory breakdown. We had 4421 this week for single family homes. That's up just 2. So not a huge gain, but still we're not losing inventory. Condos up 16. We had a net gain of 112 last week, net gain of 18 this week. Really not a huge change week over week, but still we're not losing a lot of inventory. Multifamily and foreclosures, again, really no changes here. And then total sales were 478 over the last 7 days. Out of that, 52% of them, 250 units, were cash sales. Again, a majority of the sector is cash buyers. Interest rates actually rose slightly, up 0.1% interest rate week over week, according to NerdWallet. Bank rate went up just 2 basis points. So really that's what we're seeing here, 2 basis points increase, both NerdWallet and bank rate. So not a huge change here, but still we're going to take a look at the bond market real quick in a second. So I'm just going to put this all the way up. So as you can see, the bond market right here, we have a questionable double bottom. You have the one bottom hitting here, one bottom hitting here. The 200-day moving average is on an incline. So based on that, even if this does start to head down, we're probably going to get more resistance and it's going to bounce and head higher, which means interest rates are going to be heading higher. And if the overall pattern increases as it has, we're back into this pattern that we're at right here. So this pattern is really what we're starting to see. If that is the case, we could have a pretty large streak right here where interest rates head up to the 4.5%, which means mortgage rates would go back up over 7% again, especially with the MACD and the RSI. Both are indicating we're not anywhere close to oversold, and we're actually starting to head the other way. The momentum is heading back up. So we're going to see mortgage rates start to increase again. Now I want to move on to the one story that I do want to cover this week, because the death spiral is something I have been mentioning for the last year. It was a theory that I touched on quite a ways back, but now we're starting to see things really start to play out. And these charts that I'm going to go through in this story are actually really going to show you what's going on and why this is something to keep an eye on, because this is where the economy looks to be heading right now. So welcome to the death spiral. This is from Zero Hedge. You know, take every media outlet with a grain of salt, but they do put some interesting ideas into this story. So the story and the idea of the death spiral was that governments with unlimited printing presses would spend and borrow too much, forcing their central banks to keep interest rates unnaturally low, which we have seen, to make interest costs manageable, which would encourage even more credit growth, causing inflation to spike, and so on, until everyone loses faith in fiat currencies and the misbegotten things fall to their intrinsic value of zero. So the whole idea and the whole premise behind this is really that the financial system is breaking down right now. The idea that the dollar will eventually end up becoming worthless is kind of the whole premise of this theory. And the way that it happens is what these charts are going to walk us through. If you take a look down here at this first chart, as you can see, really since 2020, the debt that our government has been incurring has really just gone parabolic. It's skyrocketing very quickly, much more quickly than any other point in history. So the Fed pushed down interest rates, which they've been doing for the last decade, which is why everything's been kind of going into what we call a bubble of sorts. The Fed pushed down interest rates, which minimize interest costs, which lulled a shockingly gullible investment community and political class into the belief that this process could continue forever. However, none of these things can continue forever, obviously. The 10-year Treasury note yield, which is what we just went over in the bond market, has gone down. We got it to almost zero, basically. And unfortunately, that means there's no more room or movement for the Fed to be able to lower rates too much further without real rates becoming negative. Arguably, they already are, but without them becoming negative, and there's no more room for the Fed to actually lower them any further. So they had to start raising interest rates so they could give themselves a little bit more room to potentially lower them again and try to continue this and kick the can further down the road. Of course, it couldn't continue forever. As the critics predicted, soaring debt required ever greater currency creation, which eventually caused the cost of living to jump, which we've all seen with inflation, 10%, leading regular people to demand that it stops. So the Fed now has to raise interest rates to counter inflation, which is where we're at. And here's where the death spiral kicks in. This year, the government's annual interest bill will break $1 trillion. Combine that with the soaring cost of Medicare and Social Security as millions of baby boomers retire, and Washington is looking at $2 trillion a year just in interest and entitlements, which it will have to borrow to fund, which will send interest costs even higher, which will require more borrowing, and so on until it all comes crashing down. So basically, we have to keep borrowing more to service our debt. And the more debt we get, the more we have to service and the more we have to borrow again. So it's just a spiral where we just have to keep borrowing more and more money to service our debt for what we've been incurring. So I'm not going to go through all these other charts, but really to the extent that the Fed knows anything, it knows this and really, really wants to force that blue line down into negative territory if possible. But it also knows that doing so will send prices spiraling out of control. Another way of saying the dollar will crash, not necessarily against the euro and the yen, which have similar problems, but against oil, lumber, eggs, milk, cars, and all the other things voters buy regularly. So commodities, for the most part, real things that we need on a day-to-day basis to survive. So there's nothing that the monetary authorities can do to stop it, because either choice, keep interest rates high or push them back down, leads to the same place, which is a currency crisis. And this, I believe, is where we get the idea that the Great Reset is going to be a resetting of the financial markets, the economies around the world, and pretty much kind of trying to restart the whole thing from zero, and everybody's on a more level playing field again. Well, that's it for this week. If you got value out of today's video, hit that like button to let me know. And if you have questions or would like a more specific market report for a community or area, please don't hesitate to reach out to me with my contact information below. I hope to see you in the next video, but until then, stay safe, stay positive, and more importantly, stay free.